Roth conversions have become the hottest topic in retirement planning. Everyone from financial advisors to bloggers is telling you to convert your traditional IRA to a Roth. And I get it. The promise of tax-free growth and no required minimum distribution sounds incredible. But Roth conversions can actually cost you more money than they save in many situations. For a significant portion of retirees, doing a Roth conversion is exactly the wrong move. I'm Josh Maley with Modern Capital, and I work with clients who have between $1 million and $5 million in retirement savings. Over the years, I've seen countless people who get sold on Roth conversions without understanding when they actually backfire. Today, I'm going to show you the real math behind Roth conversions and reveal 4 specific scenarios where keeping your money in a traditional IRA is a smarter decision. Chapter 1. Why the industry loves Roth conversions. Roth conversions do have legitimate benefits. You pay taxes now at today's rate, your money grows tax-free forever, there are no required minimum distributions at 73 or 75, and your heirs can inherit tax-free distributions under the Secure Act's 10-year rule. These are real advantages, but the industry pushes them for reasons beyond your financial success. Roth conversion strategies look sophisticated. Multi-year projections with charts make advisors appear highly skilled. They generate activity, create planning meetings, and justify premium fees. The incentives are real, and they're part of why Roth conversions have become the default recommendation rather than a carefully considered strategy. Roth conversions are a tool, not a universal solution. Like any tool, they work brilliantly in some situations and cause damage in others. I think they fall into the same category as tax loss harvesting. Buzzwords the industry loves to throw around to make people feel like they need an advisor. Chapter 2. When you're already in a low tax bracket. The math that makes or breaks Roth conversions is your tax bracket today versus your tax bracket in the future. Someone retires at 62 with $800,000 in a traditional IRA, $300,000 in a brokerage account, and Social Security benefits they haven't claimed yet. Their advisor says it's the perfect time for Roth conversions because they're in a low tax bracket. But this retiree is living off their brokerage account, paying capital gains at 0 or 15%, sitting in the 12% federal tax bracket. Their advisor recommends converting $50,000 per year, which pushes them into the 22% tax bracket. They're converting from an account where future withdrawals would be taxed at 12% and instead paying 22 to 24% today. That's paying nearly double the tax rate to avoid a lower rate later. Even with the argument that tax rates might go up, you'd need massive increases to justify paying 22 to 24% today to avoid 12% later. For 2026, a married couple filing jointly pays 12% on taxable income between $24,800 and $100,800. That's a huge range where many retirees live comfortably, especially when you consider that only 85% of Social Security income is taxable. Most retirees are in lower brackets than during their working years. They're not earning W-2 income. Drawing strategically from different accounts. When they do take traditional IRA distributions, they're filling up the 10% and 12% brackets, not the 24% or 32% they paid during their careers. If you're already in the 12% bracket or lower, paying 22% for a Roth conversion is usually backwards planning. And most people don't have the assets outside of IRA money to pay the taxes on the conversion. If you're using the conversion proceeds themselves to cover the tax bill, the math gets even worse. You're shrinking the amount that ends up in the Roth, which means you need even more growth to move the needle. If you don't have cash sitting in a non-qualified account, specifically earmarked to pay conversion taxes, you should be questioning whether the conversion makes sense at all. Chapter 3. When your heirs will be in low tax brackets. One of the biggest selling points for Roth conversions is leaving a tax-free inheritance. The Secure Act requires most non-spouse beneficiaries to empty inherited IRAs within 10 years. That sounds scary, and advisors use it to push conversions. But it matters a lot less when they imply when your heirs aren't high earners. Say you have 2 adult children, a teacher making $55,000 and a nonprofit manager making $68,000. You have $1.2 million in your traditional IRA. Converting to a Roth over a decade costs you roughly $288,000 in taxes at the 24% bracket. If they each inherit $600,000 in spread distributions over 10 years, that's $60,000 per year in additional income without considering growth. It pushes both into the 22% federal bracket. Compare. You pay 24% today, or they pay 22% spread over a decade. The 10-year rule isn't the disaster it's made out to be for beneficiaries who aren't high earners. If your heirs are in the 12 or 22% brackets, having them pay tax on inherited distributions is often better than you paying 24 or 32% today. The Roth conversions, in order to leave a tax-free legacy, start to make a lot more sense when your beneficiaries would be in the 32 to 37% brackets. If your kids are surgeons or business owners pulling in $400,000 a year, that's a different conversation. But for a teacher or a nonprofit manager, that's not a strategy, that's just giving money to the IRS early. Chapter 4, IRMAA and ACA, the hidden costs nobody mentions. This is where Roth conversions become a financial landmine. Most people focus only on their federal tax rate. They completely forget about the hidden costs triggered by higher income. IRMAA. If you're 63 or older, a large Roth conversion can trigger income-related monthly adjustment surcharges on your Medicare Part B and Part D premiums based on income from 2 years prior. I see a lot of advisors get this wrong. They think as long as we do it before 65, we're fine. But the look back starts at 63. If you're going to do conversions, you need to get them done by the end of the year you turn 62. Because otherwise, you could be hurting yourself a couple years down the road. I know someone who's a perfect example of this. She's single, widowed, and does her own investments. She sold a bunch of stock last year without thinking about the income impact. She was shocked when she found out she's now paying an extra $374 per month for Medicare. That's nearly $4,500 she didn't plan for. That's the kind of surprise a Roth conversion can trigger if you're not paying attention. For 2026, IRMAA kicks in above $109,000 for single filers or $218,000 for married couples. Say you're 64, married with $200,000 of modified adjusted growth income. Your advisor recommends a $100,000 conversion, pushing you to $300,000. You're thinking you're paying 24% or $24,000 in federal taxes. But at $300,000, your Medicare Part B premium jumps from $202 to $405 per month. That's an extra $203 per person or $4,872 per year for a couple. And don't forget that Part D surcharges would be $75, another $900 per year for a couple. Your $100,000 conversion didn't cost $24,000. It actually ended up costing you over $54,000, even though it doesn't all show up cleanly on your tax. ACA subsidies. If you're retired before 65 and on marketplace insurance, your premium tax credits are available up to 400% of the federal poverty level. Roughly $62,600 for a single person or $84,600 for a couple. Exceed that threshold by even $1 and you lose the entire subsidy. That means a 62-year-old couple with $80,000 in income receives a $12,000 annual subsidy. Their advisor recommends a $20,000 Roth conversion. Income goes to $100,000, well past the threshold. Not only do they pay $4,400 in federal tax on the conversion, but they also lose $12,000 in subsidies. That's moving the needle by over $16,000 for a $20,000 Roth conversion. If you're approaching Medicare or an ACA subsidies, you need the true cost of the conversion, not just the bracket. Chapter 5. When you're moving to a no income tax state. 9 states have no income tax in 2026. Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming. A lot of retirees move to these states, especially Florida and Texas. So here's what you don't want to do. If you live in California, New York, or New Jersey and do large Roth conversions, you're paying federal tax plus state tax. California's top rate is 13.3%. New York is 10.9%. New Jersey is 10.75%. Then 5 years later, they move to Florida and start taking traditional IRA distributions at 0 state tax. If you live in California with $150,000 in taxable income and you were to convert $80,000, you'd pay an additional 9.3% in state taxes on that conversion. If you were already planning to move to a 0 income tax state, you essentially overpaid by $7,400. Location planning needs to happen before conversion planning. If you know you're relocating to a no income tax state within 5 years, doing conversions in a high tax state is a costly mistake. And even if you think you're staying put, it's worth having the conversation because a lot of people decide to move closer to family or to a lower cost of living area once retirement gets real. And if you've already locked in California tax rates on your conversions, that money's gone. Chapter 6, the 5-year rule and liquidity. When you convert to a Roth, each conversion starts its own 5-year clock. Withdraw those converted funds before 5 years and you'll pay a 10% early withdrawal penalty even if you're over 59 and a half. You're 62, you convert $100,000 in 2026 and pay the taxes. In 2029, you have a medical emergency and need $50,000 from that Roth. That's a $5,000 penalty because the 5-year clock hasn't expired. Had you left in the traditional IRA, you could have withdrawn it any time after 59 and a half with no penalty. Just the ordinary income tax that you needed to pay anyway. If you're doing annual conversions, you're managing multiple 5-year timelines simultaneously. If most of your wealth is in IRAs and you're converting large amounts, you could be creating a liquidity problem for yourself. This is less of a concern if you have substantial assets outside retirement accounts. But for many retirees, that flexibility matters more than they realize. Chapter 7, when Roth conversions do make sense. I don't want to leave you thinking conversions are always wrong. They're just oversold. If you follow the logic of everything I've covered, the situations where conversions work are essentially the inverse. They make sense when you're in the tax valley, that period between retiring when Social Security and RMDs kick in where your income is genuinely low. If you're in the 10% or 12% bracket, filling those up with conversions is smart. They make sense when your beneficiaries are high earners in the 32 to 37% bracket. They make sense when you already live in a no-tax state. And they work much better when you have cash outside retirement accounts to pay the tax because conversions where the tax comes from the IRA itself often never break even. The key is that Roth conversions are situational. They require analysis of your current bracket, your future bracket, your heirs, situations, your states, your liquidity needs, and your full financial picture. Anyone who tells you they're always good or always bad is oversimplifying. If you've made it this far, you understand that Roth conversions are far more complex than most people realize. It's not just taxes today versus taxes tomorrow. It's Medicare surcharges, ACA subsidies, state taxes, beneficiary situations, and liquidity. This is exactly the kind of planning we do at Modern Capital. We don't use cookie cutter strategies. We analyze your specific situation, run the real numbers, and help you make decisions that actually save you money rather than just sounding sophisticated. If you have between $1 million and $5 million in retirement savings and want a second opinion on whether Roth conversions make sense for your situation, I'd encourage you to visit our website or schedule a call with our team. We're fully virtual, so we can work with you no matter where you live. The link's in the description.